So let's reach into the mailbag here. This is from listener Tim in a different market. We're in quite a few markets, so we get actually a little bit of mail, believe it or not. This says, are ETFs always better than mutual funds since the fees are lower?
Typically.
That's from Tim.
Yeah, typically. What is an ETF? Exchange Traded Fund.
That's exactly what I was going to say.
Yeah, you were all over that almost. Almost not. But anyway, so Exchange Traded Fund is just another pooled type of investment vehicle that allows you to invest in a lot of securities, and it allows you to do it with smaller dollar amounts, right? Because the share price can be different than the actual stock. Like if you don't have $2,000, and I don't know what AutoZone stock is right now, but because it's changing very rapidly in this crazy market.
Yeah.
But it's $2,200 a share, right? If you don't have $2,200, right, or you only have a certain amount in a certain account, and you need to own one share, like Fidelity and Charles Schwab. They do fractional shares, but you can you can't purchase less than one share.
Oh, gotcha.
So
that's AutoZone.
Yeah, $2,200 a share.
AutoZone is $2,200 a share?
Yeah, you should have bought it a long time ago, buddy. You missed out on the opportunity. That's called opportunity cost. That's a whole other discussion. Yeah. But anyways, the point is that you can own AutoZone.
But you have to buy the full share minimum.
But if you buy an ETF, you can obviously have a portion of it. If you're in, let's say, a mutual fund that owns 50 stocks, and AutoZone's one of them, right? And the share price of the ETF could be $20, right?
Yeah.
So you have enough to buy 1, 2, 5, 20 shares or whatever, and you own a portion of AutoZone in there. So that's the ETF is nice thing versus a mutual fund. Well, it's a lot less expensive. I mean, I'm talking 300% less expensive. It's a great article we used to hand out all the time, but we just don't see that many mutual funds anymore just because of the type of investors that we're working with. But it's called The Real Cost of Owning a Mutual Fund. And one of the Virginia Tech Hokie professors that, and I think there's actually 2 Hokies now. Yeah, I think one of them came, when he did it, he wasn't with Virginia Tech. But they're economic professors, and they had their teaching assistants. Then this was back in the 90s. They went through like 1,400 mutual funds, and they found the real cost of owning an actively traded mutual fund. What that means is one that there's managers trading the mutual fund, okay? Mm-hmm. The average inside of an IRA or a 401k, that sort of thing, the real cost was 3.17%.
Wow.
The average cost that we all know about, called the expense ratio, that's advertised on every website in the world, Morningstar, Forbes.com, CNBC, if you went and looked up the mutual fund itself, the average was 0.90.
Yeah.
So the article, going back to what it's called, the real cost of owning a mutual fund, and it was based on a big, long report that these 3 professors did. One of them's, oh my gosh, I forgot his name now anymore. But anyways, he's a professor. Oh, Edlin, that's what his name is. Richard Evans, he used to be at UVA, Gregory Cadlick. Anyways, these 3 professors did this, and it was called the Scale Effects in Mutual Fund Performance, the role of trading costs. There's a trading cost every time somebody trades, and so this cost is just eating people up. 3%.
Dang.
I've had people go, I'm not paying anything to my Edward Jones guy or my Morgan Stanley or my Wells Fargo. He's not charging me anything. No, the mutual fund's sucking out 3%. And it doesn't show up on your statement. So the difference is an advisory fee. If you're paying a fee advisor like we do, it shows up on the statement. It's transparent. There's no back end. If I'm buying this ETF or this ETF, it doesn't matter to me. We're trying to do the best for you, and we get paid directly from you. It's different, right? We're not trying to pick a fund that pays us more. We don't get paid from the mutual fund companies.
So, Tim, it sounds like the answer is yes. 866-2PLAN-4, 866-TO-PLAN, and the number 4. Hey, if you get a chance to this weekend, check out our new website. You can go to retirementplannow.com, and in the upper right corner, visit our site, because the Retirement Plan Now is kind of a landing page. But go to that and check out the new site. There's free stuff on there. Retirementplannow.com, retirementplannow.com.